Well, hello, and welcome to the 8th Annual Conference of the Golub Center for Finance and Policy, or GCFP for short, co-sponsored this year by Barclays. I think you'll agree that the topic of this year's conference, Financial Policy and the Environment, is a particularly timely one. I'm Deborah Lucas, a finance professor at MIT Sloan and the director of the GCFP. For those of you who are new to the GCFP, and as a reminder to our old friends also, I want to start with our mission. That is to serve as a catalyst for innovative, cross-disciplinary, and nonpartisan research and educational initiatives that address the unique challenges facing governments in their role as financial institutions and as regulators of the financial system. That mission is particularly relevant as it applies to the high stakes and global challenge of mitigating climate change. Arguably, it's never been more important to get financial policy right. As with most complex issues, policy choices tend to be better when they're informed by serious research and by a variety of perspectives. Something we always try to do at these conferences is to bring together leading academics, practitioners, and policymakers in a neutral setting that encourages interaction and a lively exchange of ideas. Although unfortunately we can't be together in person this year, I think the variety of topics and perspectives on the program will achieve that goal over the next 2 days. For those of you in the audience that have questions, you can submit them via the Q&A function over Zoom. The session moderators will try to get to as many of those that they can. And now it's my pleasure to introduce C.S. Venkatakrishnan, Barclays Head of Global Markets and co-president of Barclays Bank. He'll say a few words and introduce our keynote speaker. But before I go on, I wonder if you could take down the introductory slides so that we can see everyone in full face. Thank you. And Venkat, the floor is all yours.
Thank you so much, Debbie. It's a really great pleasure for me and for Barclays to be involved here for the second successive year in co-sponsoring this conference. I think that the Golub Center for Finance and Policy and MIT have played this leading role for the last many years in bringing post-financial crisis important issues for discussion and debate. And as Debbie said, with a broad group of academics, policymakers, and practitioners. And it's wonderful for Barclays to be joining in this. I have great pleasure today in not just welcoming you to the conference, but welcoming you to the first session, which is with Sarah Breeden. Sarah Breeden is the Executive Director for Financial Stability, Strategy, and Risk, and a member of the Financial Policy Committee at the Bank of England. And the FPC, or the Financial Policy Committee, is tasked by the Parliament in the UK to be the guardian, basically, for the UK financial system against damage to the broader economy from financial problems. Importantly for this conference, Sarah, since 2016, has been leading the work for the Bank of England domestically and I would say internationally on the role of financial regulators and central banks on managing the harmful effects of climate change. This has included being chair of a macro financial work stream for international central banks and supervisors. And what I would say is, in my personal and humble opinion, the Bank of England has taken a leading role among central banks. They were early and they were big. I would say at a personal level, there are very few times in life that you could sort of remember specific meetings or specific conversations which change the way you think. And about 3 years ago, I'd had one such conversation with Sarah, well before the Bank of England mandated stress tests or analyses of banks' financial exposures, and where Sarah was extremely persuasive to me. And I came in as a skeptic about the importance of addressing climate change through the financial systems and through banks. I'm very happy to say that starting from that day, Barclays has tried very hard to be on the front foot on this. We did an internal stress test to test our own exposures and vulnerability to climate change before it was mandated to do so. We have expressed an ambition to be a net zero bank in scope 1, 2, and 3 by 2050. We have begun a transition away from financing of those sectors, including fossil fuels, which have a particularly harmful effect on the economy. And I can very much point to that meeting with Sarah, that dinner in London a few years ago, which helped at least me start that journey and to whatever degree help influence the bank. So, so I hope you'll find her as persuasive as I did. I'm sure you will. Sarah, thank you so much for joining us.
Thank you very much, Venkat. Thank you, Deborah, too. It's a real honor and a privilege to be with you today, speaking to the greatest minds on the defining topic of our generation. And I hope together we'll be able to deliver some serious research that drives the right policy and so the right outcome. We're now only 11 days away from COP26 in Glasgow. Climate science tells us that the planet has already warmed by about 1.1 degrees Celsius relative to pre-industrial times. And indeed, the news is full of the devastating effects of physical changes already taking place around us. Existing commitments from countries to reduce greenhouse gas emissions are not enough to keep warming to well below 2 degrees, let alone 1.5 degrees. And the United Nations Intergovernmental Panel on Climate Change estimates we're going to reach 1.5 degrees by 2040, even under their very low emissions scenario. So failure to formulate more ambitious commitments and deliver against them this decade will mean we miss the last opportunity significantly to deter the course of climate change. The case for action is clear. The question is whether our actions will match that case, in particular, whether we turn aspiration into action on the scale required. Delivering a path to net zero requires all of us to take necessary steps, governments and business, investors and individuals, as well as central banks and financial regulators and the financial system. Here at the Bank of England, we've taken a range of actions in line with our objectives, including setting expectations for Barclays, banks and insurance companies generally on their approaches to managing climate-related financial risks, running a system-wide climate scenario exercise and setting out how to green our own balance sheet with our corporate bond purchase scheme. All of that is designed to help us play our part in the transition to a net zero economy. Through all of this work, one thing has become abundantly clear to me, that the actions we take today will determine the consequences we face in the years to come. And so if we are to take the right decisions today, we need to stretch our horizons, take different decisions today, well before the consequences of that inaction manifest at scale. This needs to occur across the entire economy, and the financial system needs to be a key enabler. As central bank and financial regulator, these implications put climate change squarely within our remit. We cannot solve climate change and drive the transition. Those with the responsibility and tools to do this sit elsewhere in government and in industry. But we must ensure that the financial system is resilient to climate-related financial risks, that it can support the transition, and that we understand its macroeconomic impacts. So today, I want to speak specifically on the system-wide and economy-wide impacts of climate change, using insights from the most recent work we've done on climate scenarios through the Central Bank and Supervisors Network for Greening the Financial System that Venkat mentioned before, the NGFS. I'll aim to cover three things. First, the lessons we've learned from designing climate scenarios. Second, the lessons we've learned from applying them. And third, I'll share some thoughts on the future of scenario analysis, including the absolutely vital contribution that research needs to make. So, the first step in understanding the impact of climate change to the macroeconomy and the financial system is to recognize that we need to look forwards, not backwards. The risks from climate change are unprecedented. They cannot be assessed solely by looking at past data. And depending on our actions today, we could see fundamentally different future outcomes, from a hothouse world with extreme physical risks to futures where we limit the worst effects of climate change, but perhaps with very high transition risks along the way. While it's certain that a combination of these risks will materialize, it is not clear which path we are on. And to navigate these various future pathways and to understand what future financial risks and economic costs we may see, central banks and financial regulators have turned to scenario analysis. Now, scenario analysis is fiendishly complicated. This figure highlights that the transmission channels from climate risks to economic and financial risks are numerous, with significant interdependencies. A holistic analysis, therefore, requires macroeconomic top-down approaches to be complemented and augmented by granular and bottom-up risk assessments. A major challenge to doing this is that the prerequisite data and methodologies to translate the climate outcomes on the left into the macroeconomic and financial risks in the middle and on the right are incomplete and inadequate. And of course, the future path of the climate risks themselves is subject to huge uncertainty. All of this means any such exercise is complex and complicated. To support central bank supervisors and the financial system with the assessment of these risks, and to try and bridge some of these modelling and data gaps, in 2019, we launched a project to co-design climate scenarios with a consortium of world-leading climate scientists and close to 60 other central banks and supervisors under the macro financial workstream of the NGFS. In June of this year, we published the most recent version of our scenarios. And as chair of this workstream, I am very proud of the progress that we've made in just a few years and the lessons we have learned along the way. Let me share just a few of those with you. Although we often emphasize the uncertainties inherent in climate projections, it's worth emphasizing how much we already know. The scientific basis is unequivocal, and we also have a clear picture of where our emissions come from and how they can be reduced. So we know what the building blocks of the transition are, from increasing the share of renewables in the energy mix to more sustainable buildings and agriculture, alongside carbon capturing and offsetting where possible, whether through new technologies or nature-based solutions like afforestation. And a number of different types of policy measures can help us get there. We've also learned that the cost to the economy in aggregate of getting to net zero need not be substantial. Our latest economic modelling suggests that reaching net zero, if the transition is managed well, might have a small or negligible effect on economic aggregates such as GDP, unemployment, and inflation. The sixth carbon budget produced by the UK Committee on Climate Change estimates that the net cost of the transition will be equivalent to less than 1% of GDP over 2020 to 2050. But we also know that these costs depend on whether the transition is orderly or disorderly, and that it takes time to implement policy and for markets to adapt to the changes they require. That means that if meaningful action is delayed by another decade, the transition would need to be much sharper. The NGFS estimate that GDP in 2050 would be at least 5 percentage points lower than it would have been if we acted today, even before we begin to account for possible feedback loops, for example, if losses in the financial sector amplify the slowdown in the real economy. And of course, the longer we leave meaningful adjustment, the greater the physical risks, leading to higher costs, particularly later in the century. On that, my third observation is that those impacts from physical risk will be significant. Analysis that we have undertaken in the NGFS indicates that even if we limit the rise in global mean temperatures to 1.5 degrees, physical risks will dominate the potential transition risks. And if instead we continue on our current trajectory well above Paris goals, global losses just from the impact of physical risks on labour and agricultural productivity could be as high as 13% of GDP by the end of the century. And that's before we account for sea level rise, more extreme weather events, food insecurity, mass migration, and displacement of people. This number is therefore very much a lower bound. And as high levels of warming are completely unprecedented, we should remain humble that we're unlikely to be able fully to capture the delicate balance between the climate, living conditions, ecosystems, and the economy with the models that we have at our disposal. Now, clearly, investment is needed to help adapt to these inevitable physical changes, which in turn should reduce damages. The Global Commission on Adaptation, for example, estimates that $1.8 trillion of global investment in adaptation this decade could generate more than $7 trillion in net benefits. In our focus on the transition to net zero, we must not forget the need to build resilience and to adapt to these physical risks. So what do I take from all this? Two things. The cold, hard climate physics could not be clearer in underlining the importance of early action. And second, the returns to investment in mitigating and adapting to climate change now are high. So far, I've spoken about some of the key lessons learned while designing the NGFS scenarios. I want now to turn to what we have learned from applying these scenarios to macroeconomic and financial risk assessment. Many central banks and financial supervisors are already using climate scenarios to assess the risk to their economies and their financial systems. Yesterday, we published a report surveying the climate scenario exercises of 30 NGFS members. At the moment, only 4 of these exercises have been completed with their results published, but things are developing rapidly in this field and another 21 exercises are scheduled to be completed within the next 12 months. And it's been absolutely thrilling to see the NGFS scenarios serve as a foundational component in the significant majority of these exercises. The objectives of the climate scenario exercises undertaken by NGFS members vary. While all exercises aim to assess risks, the focus of the assessment ranges from risk to individual institutions, to risk to the wider financial system, to risk to the broader economy. Moreover, as most of us are doing this type of climate scenario analysis for the first time, it's often equally as important to promote an awareness of the risks and to develop capabilities for assessing them, just as much as it is to quantify the risks. Learning by doing, you might say. The scope of the exercises varies as well. All exercises surveyed in the report cover the banking sector, and about half of them include additional financial firms, such as insurers and pension funds. All but one exercise includes transition risks, and about half of the exercises cover the physical risk from climate change too. This might seem strange, but there are two key reasons why some exercises have chosen not to cover physical risks. Firstly, transition risks are seen as a more pressing matter for certain sectors, such as banking. And secondly, transition risks are comparatively easier to model. However, a comprehensive risk assessment will require us to look at both types of risk. And I expect this to increasingly happen as our methodologies for analysing the risks improve. To date, only one of the exercises surveyed includes climate litigation, the Bank of England's own Climate Biennial Exploratory Scenario, or CBES. That reflects the complexities associated with modelling this risk. But across the world, there are increasing numbers of climate-related cases being litigated. The impacts of such litigation can pose material financial risks to firms and create uncertainty over their operating environment. This could have a material impact on the stability of defendant companies, creating risks for investors, insurers, and the wider financial system. So we need to continue to adapt future scenario analyses to capture as many of these interactions as possible. Our report also highlights a number of challenges that central banks and supervisors have encountered when applying climate scenario exercises. First, immaturity in this complex field means further enhancements are needed. The NGFS scenarios are a critical component in the significant majority of the exercises that we surveyed. These scenarios have been designed to be flexible, and indeed we're seeing individual NGFS members build on them in their own exercises by tailoring them to the specific needs of their jurisdiction. In the last 2 years, we've made huge strides in adding country-level data for hundreds of variables, which can support jurisdiction-specific assessment. But even so, more development is needed. Second, data challenges take time to resolve. Even though scenario analysis helps generate relevant data that can help build the full picture, it's a gradual process, and getting the right data to undertake scenario analysis remains a key challenge. And then third, uncertainties remain about the estimates of macroeconomic and financial impacts. Although we've a good sense of the direction of the impacts from climate change, there's still much uncertainty around their exact size and composition. And this begins with the underlying physics. Projections of future temperature rises are subject to uncertainty bands, especially in scenarios with high emissions. And there's also uncertainty about the pace and composition of the transition. So it's important to make our methodologies robust, considering multiple scenarios and outcomes rather than single estimates. In the light of these challenges, no members are of yet envisaging calibrating regulatory capital requirements on the basis of their exercises. However, some have expressed interest in this topic and indicated that they may include it as an objective for future exercises. Now, technical design features can be useful in dealing with the challenges I just described. Let me draw out 2 points. Firstly, on the type of scenario exercise being undertaken. Some climate scenario exercises are conducted entirely by the central bank or supervisor, where they use existing data sets at their disposal to make scenario-based calculations, what we often refer to as desk-based exercises. Others have adopted an approach where financial firms themselves are responsible for calculating the scenario impact based on the scenario that the regulator has provided them with, similar to how traditional stress tests are conducted. Exercises are split evenly between these 2 types, highlighting that each is useful for different reasons. If financial firms make the calculations, they're forced to collect relevant data and build up their internal risk management capabilities and their awareness of climate-related risks. But this can make comparability tricky as firms take different approaches. And if the regulator leads the exercise, the methodology applied can be instead consistent across firms. A top-down exercise is also often a simpler and quicker approach. Secondly, there are differences on time horizons and assumptions. Most exercises look at a time horizon of 30 years, consistent with the fact that most emissions reductions need to take place over the next 3 decades if we are to meet the Paris goals. Some exercises look further into the future to include the more extreme physical risks that could arise later in the century. And there are also exercises that look at shorter horizons of just a few years. An issue when looking at longer time horizons is that exposures can change over time. Financial firms continually adjust their exposures to manage risks while aiming to profit from new opportunities. But if we assume they do this perfectly, we would by definition find that the risks they face directly are very small. But of course, firms would continue to face indirect risks as temperatures rise. It's not possible for firms in the financial sector as a whole to diversify away its exposure to the planet. And we know perfect management of even firms' own direct exposures does not always happen perfectly, especially in stress, as might occur with a sudden adjustment in asset prices, a so-called climate Minsky moment. And we are, of course, interested in understanding what would happen if firms fail to adjust their business models or manage the risks adequately. To assess the full size of the risks, 3/4 of climate scenario exercises therefore assume that financial firms' balance sheets are frozen in time. It's a huge simplification, but it allows the climate-specific impacts through the course of the exercise to be easily identified. Others have instead allowed for changes to balance sheets to be modelled, sometimes subject to some restrictions. Understanding these technical aspects of climate scenario exercises is crucial if we are properly to appreciate and contextualise the results. The Bank of England is also dealing with these complex challenges and design choices through our CBES, which we launched this summer, and the results of which are due to be published next year. As I hope you've appreciated, we've learned a lot from designing and applying climate scenarios, but this is honestly just the beginning. There's so much more that we need to do, iteratively adjusting the nuts and bolts in the models. And even when we think we've got it right, I am sure we will find further room for improvement. Central banks and supervisors have a lot to gain from these improvements, as this will help us better understand how climate risks affect the financial system and the economic outlook, and so we can best consider our potential policy responses. We will therefore continue to share our experiences, and we plan to publish further reports in the future to summarise the collective progress we've made. We'll also continue to approve the NGFS scenarios themselves. We're working on adding more sectoral details to the scenarios so the distribution of risk across the economy becomes more apparent, and also to include more physical risk so the cost of inaction becomes even clearer. But we need your help too. And let me highlight a handful of areas where more research is needed and where scenario analysis can be usefully applied. First, policy levers. Our NGFS scenarios use a shadow carbon price, which serves as a proxy for a range of different potential climate policies, whether carbon taxes, outright business regulation, or subsidised investment in research. In aggregate, climate policies will need to create the relative price shift that internalises the cost of emissions and drives that economy-wide shift to net zero. Our NGFS analysis suggests that these will need to add up to an equivalent global shadow carbon price of over $150 a tonne within a decade if we are to reach net zero by 2050 in an orderly way. Estimates of the average global price of carbon today are nowhere near that, meaning that investments being made today lack crucial pricing signals that could fundamentally change investors' decisions. In that context, further research to anticipate the challenges and the opportunities that come with different approaches to climate policy and carbon pricing, to further understand the right mix of policy tools to support a swift yet smooth transition to net zero, and to develop comprehensive frameworks to better capture the impact of this mix of tools on the economy are essential. Second, on macroeconomic implications, we've identified 3 key areas where we think there's a need for further work and research. Firstly, further integrating climate and macro modelling. Climate models typically don't model the economy in much detail, and macro models don't capture climate risks very well. So we need to do more work on integrating models across the different disciplines if we are to do a better job of understanding what might happen. Increasing the economic resolution of our climate modelling is essential. Second, understanding and sizing different transmission channels and improving our understanding of how they interact will be key. And then thirdly, going beyond aggregate impacts to understand distributional implications across sectors and geographies. Finally, research around the monetary policy implications of climate change and the transition to net zero have only recently started to emerge. We know that domestic and international climate policy will have an impact on inflation, growth, and labour markets. It's also clear that the physical risk from climate change will impact macro variables. Changes in weather patterns and increased reliance on bioenergy could increase the volatility of food and energy prices, and hence the volatility of headline inflation rates. Indeed, we're having a sense of that right now. And we know too that the impacts will become larger if we fail to act at all. We also know that to meet climate goals, we need a structural shift across the economy, and that will affect expected long-run steady-state variables, whether the natural rate of interest, R star, or the natural rate of unemployment, all of which matter a lot for monetary policymakers. The unknowns I've just talked through, policy levers, macroeconomic impacts, monetary policy impacts, are all ripe areas for further research. These efforts will not only help central banks and supervisors, but will also help ensure that the NGFS scenarios themselves are better and can continue to be used by financial institutions in the private sector, by industry and policymakers more broadly for their own purposes. We'll continue our dialogue with these stakeholders and take on their feedback as we determine where to take the NGFS scenarios next. Let me conclude. Climate scenario analysis is of fundamental importance in managing the risks from climate change, helping us to chart the course to net zero and drive different decisions today. As stewards of the financial system, scenario analysis must remain a core component of the central bank and supervisory toolkit. Indeed, our supervisory work has also indicated that scenario analysis is an area where our regulated firms need to do more too. Our case study report shows the extent to which these scenarios are being applied already, and our international engagement this year, including through the NGFS, the G7, the G20, and the Financial Stability Board, has shown us that scenario analysis is becoming an increasingly important tool for financial institutions, businesses, policymakers, and academia all around the globe. As I said at the start, we're just 11 days away from COP26, and the science tells us we're fast approaching a point of no return for the planet. That means we all need to work together to understand the risks, to develop the analytical capabilities and formulate the solutions. It's an ambitious ask, but humanity is best placed to achieve the impossible. When there's a will and when there's a way, let's get to work. Thank you.
Sarah, thank you so much for your very insightful remarks and full research agenda for the researchers among us to try to make progress on these challenging issues. I don't think we had planned to pepper you with questions, so unless there's something you'd like to add, let me just quickly look. I don't know if you're willing to answer a question.
Happy, always okay, happy.
Great. So a reminder then to the audience that that there's this possibility. Just 1 second.
Deborah, what I could do, if you'd like, is talk through how we've approached our climate scenario analysis at the Bank of England, dive a little bit into some of the choices that we've made and what we would hope to get from that exercise, if that would help.
That could be very helpful. I'm just actually scanning the questions, and there is one that's also always on my mind. So maybe I'll throw that out, and then you could maybe turn to that, if that's okay.
Sure. Sure.
Which is the question of while the cost to net zero for developed economies such as the UK, it may not be overwhelming. The cost will likely be significantly larger for developing economies, and a longer time is necessary to make the necessary adjustments, lack of expertise, lack of resources. So beyond carbon pricing, which directly impacts trade, investments, and economic activities, what role should the UK and other developed economies be playing to nurture the net zero transition in Commonwealth jurisdictions or trading partners?
So, of course, that's a great question. And we all know that we only get to a stable climate outcome if the whole world gets to net zero, not just the developed world. And I'd make a couple of points. The first is that in some respects, it may be possible for emerging economies to leapfrog that carbon stage and just go straight to a decarbonized world. So for those that are still building their infrastructure, skipping that carbon intensive phase and getting to a decarbonized world is certainly possible. But it is absolutely the case that the investment required to support those countries as they become wealthier, as they grow, as they grow in a carbon-friendly way is significant. One of the things that I think our scenarios are really helpful in highlighting is where change needs to happen, where finance is needed. And I think what that can do is then enable institutions in the financial system to say what is financeable and what is not. Our aim through our exercise in the Bank of England's Climate Bears is to ask our firms to highlight how they would react to these risks as they materialize, what business they would cease doing and what business they would start doing. Through that, we'll be able to get a sense of what of the transition is going to be financed and what of the transition is not easily financed by the private sector alone. And I think that's useful information for us, because then we're thinking about how do public-private partnerships together drive the investment that is needed, the role of blended finance, where private sector brings trillions of dollars, but the public sector takes the risk that the private sector is unable to take is an obvious place to start. So I very much recognize the problem. I think leapfrogging in terms of technology is part of the solution, but it's clear that financing is needed and highlighting what is financeable by the private sector and where the public and private sector need to work together is going to be, I hope, an important outcome from the sorts of scenario analyses that we're doing.
Great. So that's very helpful. And I didn't really want to interrupt your train of thought. So if you did want to address what you had suggested, please go ahead.
Well, look, why don't I just briefly talk about the 3 aims of our climate exercise that we're doing, just because it helps bring to life, I think, what different decisions we want to drive. Our exercise is ambitious. We have given ourselves 3 goals. Firstly, to try and size the risk, to shine a light on the risks that are currently opaque. Secondly, to get banks and insurers, those that are participating in the exercise, to explain to us in qualitative terms how they would react as these scenarios unfold, so that we can see what business stops being done and what business needs to be done if we are to drive the transition. And then the third thing we are aiming to do is drive improvements in risk management capabilities. I said at the start that we're all learning by doing here, and the climate BES is an example of that. And I hope, therefore, it will deliver some lasting benefits to firms like Barclays. What we're doing is looking at 3 different scenarios because we don't know what future world we're going to face. We'll look at a world where there's no additional policy action, one where we make the transition to net zero and we start today, and one where we make the transition to net zero, but we start late. We're looking ahead 30 years because we want to stretch horizons so that firms get strategic and realize that action now is the lowest risk, driving an alignment of strategy and the orderly transition to net zero. We're covering physical risk, transition risk, litigation risk. That's really tough, but it's the world that we live in. We're really granular. We're asking our firms to engage with their counterparties to understand what is their exposure to these risks. We're looking at where houses are, what postcodes they're in, and therefore what physical risk they'll see. We're looking at what individual energy performance is like of individual houses. So we're trying to do that bottom-up analysis of the risks. We're holding the balance sheet static because we don't want everybody assuming the problems away. But as I said, we're going to ask firms how they would react. And the final thing is that we're covering banks and insurers because of the read across between the two. Banks determining not to lend to certain corporates will have consequences for insurers' asset portfolios. Insurers deciding no longer to insure certain risks will have consequences for banks' credit risk. All of that means it's a real ask of firms like Barclays, but I really hope that we'll get a rich sense of where the risks are, what change needs to happen, and, as I say, drive some lasting improvements in risk management from here.
That's great. If you have time for one more question, another interesting one actually came in earlier. I think it's a hard question, as many of these are, but let me paraphrase it a little bit. But, we have what appears to be an evolving energy crisis right now, and it is one of the drivers of inflation. Some call it greenflation. from decommissioning fossil fuels rapidly, perhaps. The question has to do with whether it's influencing the scenarios, the plausible scenarios that you run or the weight that you put on them. So you might think of this as kind of a political transition risk. And to what extent do you take into account political pushback as a risk in all of this?
So it's a great question, and let me answer it in two ways. The first, narrowly, is that the scenarios that we have got out there and live right now are ones that were finalized with data up until 2020. So the narrow answer to the question is they are not incorporated in the current scenarios, but of course we'll have to take them into account when we do our next regular update. The kind of two broader points that I'd say about that, though, is the first is what the scenarios are trying to do is highlight possible future risks so that we can try and think about how best to manage them, so that we don't, to put it extremely, pull the plug out and have very high inflation in energy prices if there is a way that we can achieve our goal of net zero by acting in an orderly manner. So what we're trying to do through our early orderly transition scenarios is give a sense of what the best way of getting to net zero is. But what is kind of highlighted through the recent inflation that we've seen is that trying to the sharp adjustments in energy prices have real economic consequences now, and therefore the more clarity there is about climate policy, the easier it is for everybody to plan around that, and in so doing try to have an orderly transition. The political point you make, Deborah, is one I recognise. There is a question of timing as to when to do this. There is a question of how to make any transition a just transition. Those are for politicians rather than for central banks and supervisors. But what we can do through the scenarios is highlight the costs of inaction, and in so doing, at least bring something, I hope, to the debate.
Great. Well, thank you very much for all of that insight. And I think we have, if there's nothing you want to add, I think we're going to take a 5-minute break, and then we'll be starting our next panel very soon. So Sarah, again, many thanks and take care.
My pleasure. Thank you.